Today, fear is walking the halls. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. In this quick update, I just look at the results from the local market today. And it's a doozy. After the US falls earlier on, it was no surprise that our markets went lower. But the depth of the fall and the width across the market is quite surprising. The local fear index, or the VIX, was up 53.37% to 2178, which is nearly as high as back in February, where it went to just above 22. This is an indication of the amount of uncertainty in the market. The ASX 100 ended up down 2.7% to 4,839. Now, that is still well above its 4,040 level, which is where it fell to in February 2016. But nevertheless, it's a significant correction. The ASX 200 Financials Index, which is all those shares in the finance sector, fell 2.9% to end at 5,741. Now, that is as low as it's been since March 2016, when it briefly went down to 5,466. The financial sector continues to underperform the market, and possibly today's CEO evidence hearings did little to help. The Aussie US dollar ended at 70.73. It was actually up 0.34% over the day, but is still sitting at the low end of its recent range. And I think the expectation has to be that it will drop lower again. And just to complete the picture, the spot gold Aussie dollar rate was 1,688. That was 1% higher on the day and continues a trend that we've been seeing since early September in response to the Aussie dollar falling. So to my mind, the key question we have to ask ourselves is this just a brief hiccup? And will the markets return to their previous direction? Or are we going to see more falls in the days ahead? It's too early to tell, really. But my own perspective is that the news from the US with regard to higher interest rates, higher expectations of inflation, and all the other economic indicators, they're all suggesting that interest rates in the US are going to rise probably more quickly. That's going to lift the costs of borrowing, particularly some corporates. And in addition, the trade wars, as those tariffs get imposed, will put extra cost pressures of imports into the US. And as a result of that, again, it looks as though inflation may rise, and that in turn may lift interest rates higher. So I think that we're in the situation where all of that cheap money that was sloshing around in the system for years, stoking asset bubbles, whether it be home prices or whether it be stock prices, is now very much under the microscope. And I continue to believe that we will have further down trends over the next few weeks. It won't be continuous, it won't be linear, but I do think there are further corrections ahead. And in terms of our local market, there really is very little in terms of news that may suggest other than continued weakness. That, of course, translates ultimately to higher funding for the banks, higher mortgage rates, and therefore more pressure on households. So I'll be watching events over the next couple of days quite closely, and I'll give you a further update as things progress. If you found this useful, please do like the post and add a comment or question. I read them all. And if you haven't subscribed, please do so to receive future updates. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.